This is Michael and welcome to LTG GoldRock Stocks. In this video, we're going to look at the LTG checklist tool. So it's a stock checklist tool to help you research companies, particularly on the ASX, to determine whether they have good quality, good stability, and long-term potential. So you've got the section up the top here. You can generate a PDF when you're done so that you can save all of your notes. And then down the bottom here, you can set the stock code, stock name, current price, research dates automatically populated, and you can pop in your own notes. So dividend may be paid from capital sale, something like that. And that'll pop out when you hit generate PDF so that you can keep track of what you've actually researched, what score that it has, and that way you can compare the different stocks that you research to see which one scores better on the checklist score, but also has the notes that match what you're looking for as well. So it's a really handy way to keep track of what you're actually doing. It's easy to share, so you've got Facebook, LinkedIn, X, or old Twitter. You can copy the link here as well. Share your research with others if nice and easy to get that out there and share your intel. So let's start off with question one. So is the company generating consistent operating profits? Now, what it means by operating profits is sometimes you've got to watch companies sell off assets and claim that as revenue. Revenue off the sale of an asset probably isn't going to occur next year or the year after and continue on over the next 50 years. So operating profits is something that you need to be, I guess, a bit cautious of, because if it's from the sale of an asset, then it's not really going to continue. So you want operating profit particularly. Now, is that company that you're researching generating consistent operating profits? And obviously, if you're not sure, then come and check out our starter program so you can see those weekly webinars. We take you through how to look for operating profits, how to read the P&L, how to read the balance sheet. Question number two, is the stock trading below a reasonable estimate of its intrinsic value? So the intrinsic value is essentially the value of that stock that it should be sitting at based on a series of calculations. Obviously, there's a lot more to it than just the intrinsic value, but it's a really good guide as to whether there is value for that stock. It's not only is the company doing well, it's also about what price is that stock at, because if it's valued way higher than the returns it's getting, it might be really high returns. From a profit point of view, if the stock price is 100 times more or 200 times more than that profit that it's bringing in, perhaps it's not the best asset that you can invest in right now. Is the stock trading below a reasonable estimate of intrinsic value? So that's basically, is the stock price below where it should be? Just before we go on to number three, the intrinsic value is something that we share in the stock screener. So if you haven't got the stock screener, go and get it, because it gives you the intrinsic value off the basis of a fund manager report style calculation. It sits right next to the stock as to what the intrinsic value sits at based on the blanket rule that we use, and it helps people easily filter out stocks that are probably best to research compared to companies that aren't making money and are overvalued. If you're not sure about intrinsic value, the stock screener is the way to go. Is the stock trading below its book value or adjusted asset value? So number three is talking about the assets of the company in effect. So how much asset value sits against that stock? Some stocks might have no assets. Some stocks might have, let's say, $1 worth of asset per share, and the stock might be trading at 90 cents. So the book value would actually be above the stock price in that scenario. While most stocks will be the book value, it just makes sense because they're generating income, that kind of thing. It does help create value when you look at the assets that the stock actually holds as well. Number four, did one-off asset sales materially inflate earnings this year? So one thing with many companies is sometimes they'll sell an asset. It might be a mine site, it might be a plant or a factory, it might be a series of vehicles or software licensing. They might sell an asset that materially inflates the earnings for that year, and it looks like they're making a lot of money. But then because it was an asset sale, they're not going to do that again next year, most likely. They can't sell the same asset because they've already gotten rid of it. So has that asset sale had a big impact on overall revenue in effect? Now, when we're scoring this, we're not just saying yes or no. We're sliding the rule between a 1 and 5. So for example, is the company generating consistent operating profits? If it's not generating anything or it's making a loss, I might score that at 0. But if the company is making very good returns off its operating profits, then I might give it a 4 or a 5. If it's somewhere in the middle, you might choose to go 2 or 3, for example. So you're using these sliders as a guide as to how you feel about that question, and you're ranking it from 0 to 5. And at the end, you'll have a total score. And as you go through and research multiple stocks, you'll be able to compare each checklist score and then make a better decision as to which company may have more value overall without trying to think about it all at once without a clear strategy and plan. So does the company have a credible path for future growth or improvement? So this is where we look at the management and I guess the long-term view on what the stock is going to do and the company itself. Let's say you're looking at an AI stock. AI is hot right now at the time of this video. Is the company that you're looking at utilizing AI for massive future growth and improvement in an industry that's going quite well? Or is the company kind of waiting for opportunities to buy certain assets? Or is it really just plodding along and doing what it does and doing what it has done for the last 5 or 10 years? So we're looking at future growth and improvement, not necessarily is it doing okay right now, but what is the future of that company? And are management making good decisions for the future? Number 6, are its core products and assets likely to hold or gain value over time? Let's think about gold miners, for example, in this case. Let's say you bought a gold miner 2 or 3 years ago and its core product, gold, has rallied quite a bit. So gold doubled over the last couple of years. And the underlying assets, let's say the core product and assets, it had a massive gold store that it hasn't sold off yet. It's sitting there waiting to be sold off. That company owns an asset that did gain value over time, looking back. So it's about looking at the core products and assets that it currently holds and trying to understand what the valuation of those commodities or the products or the assets hold. Think about McDonald's, for example, that its strategy was about buying property and owning that property all around the world. The asset value of all of that property has grown massively. So that's something to consider, is what assets does it hold? Is it being strategic with those assets? And are they likely to gain value over time? Next question, number 7. Does management have track record of responsible, effective decisions? So you can actually look up who the management team are, what the historic decisions have been by looking back where they've worked previously. Has that company done well? What were their decisions and what was their impact in those companies or in the same company so far to date? Have they been making good decisions that impact the business positively? Also look out for the negative side too. So if management are paying out dividends, for example, that are coming from capital sales, and they don't have a plan to actually utilize that money, so they just pay it as dividends and keep shareholders happy to some degree, they're not actually thinking of the future and putting in energy to actually create benefit from the company or the investment. Number 8, are dividends supported by cash flow with sustainable payout ratios? So this kind of ties into that management decision where if they sold an asset, they pay out all of that money where they could be potentially using that money to buy other assets that will create value for the shareholders rather than just paying it out as cash. Looking for sustainable payout ratios by management, and that comes down to, I guess, responsible management decisions, and do they have a use for cash? And if they don't, perhaps your money is better somewhere else as well. Are there clear risks or headwinds that could impact the company? Sometimes there are risks with companies that could be due to regulation, geopolitical stance, geographic location, or the industry itself. So for example, let's look at Blockbuster. Clear risks for Blockbuster were that people could download videos and content straight from their computer or mobile or TV. So that was a clear risk that the industry was moving towards that direction. You no longer need to go visit a store to watch movies. On the flip side, you've got headwinds. So for example, there was a company that had massive loans on big assets, and the management team was able to negotiate a better rate across all of their lending, which effectively saved the company about 10% on all those assets, which is a huge amount when you talk about the scale that they were dealing in. So that was a massive headwind that was coming for that company if they got approved. So considering things like that, clear risks and headwinds in the future of the company, it's a really important part of assessing their future. Number 10, is the sector supported by long-term structural growth trends? So when you look at medical, for example, or pharmaceuticals, you've got an aging population in many countries, and a long-term growth trend is that that aging population often needs more medical help, and therefore those companies that support that will do better, provided they're set up correctly and they're operated well. Question 11. Does the company maintain manageable debt relative to earnings and assets? When it comes to debt, it's important that a company generally has some debt, particularly when rates are low. When I mean rates, I'm talking interest rates, so the cost of debt. If that debt is less than what the management expect to be able to return for that money, so for example, let's say they have a $100,000 loan, the interest on that is say $5,000, they would expect to make more than $5,000 from that debt per annum, meaning that they have confidence in their asset being worth more than the cost of debt. In essence, debt is a sign that management believe that with money, they can actually earn a better rate of return than the cost of debt itself. While debt isn't always seen in a positive light, debt can be a good indication of confidence in management being able to return more than the cost of debt from what they're actually doing. So providing services, building products, and earning more in profit than it will cost them. Number 12, is operating cash flow consistently positive and aligned with earnings? Operating cash flow consistently positive. Now, sometimes companies may have years where they don't earn positive cash flow. And in terms of aligning with the earnings, it's about looking at the total revenue versus the costs and seeing if there's a mismatch. So for example, are some years, are they spending way too much money than they should be, or is it consistently growing in line with the earnings that they're getting? So are they spending too much? Are they spending not enough? Is there a mismatch? For example, if they spend too much in the year before and then not enough in the next year, does it decline the earnings? That kind of thing. So looking out for the cash flow consistency in line with the earnings is an important concept for long-term growth and sustainability. Number 13, has the company avoided excessive share dilution in recent years? Share dilution happens when the management issue shares, and when they issue shares, they create more shares in a sense that people can buy, and that raises capital. Now, capital raised could be a good thing. However, those people who already hold shares, it means that their share value is essentially diluted or decreased. What you would want to happen in that scenario is that capital is actually used to earn a lot more money. However, often share dilution simply just devalues the stock that you have. So avoiding excessive share dilution. On the flip side, when you see a company is doing a share buyback, so they're actually reducing the amount of shares that are available, often what they'll do is they'll buy the shares back as the company and then they'll cancel them. And that is the opposite of share dilution. And often that's really quite a good thing, and it's the company saying that these shares are undervalued, so we're going to use that money that we have available to buy those shares back because the value of the company is actually worth more, and they know that. Has revenue been stable or improving over multiple periods? So looking at the revenue, is that increasing? So their ability to earn an income, not necessarily a profit, because what they can do with the bigger revenue is sometimes, if it's always improving, they can manage the costs on the other side at some point in the future and then become profitable. Has revenue been stable or improving over multiple periods? When you see a revenue figure that is far too large comparative to previous years, sometimes that is because they've sold off a capital asset, and that's not really the type of revenue that you're looking for in an investment. So just be careful with the revenue. Is it stable and improving, or has there been big spikes and all of a sudden there's a huge rush about the company, but we need to actually look at where that revenue is coming from and is it stable or going to improve in the future. Number 15, does the company have defensible advantages versus competitors? Defensible advantages could be things like brand power, network effects like Facebook and Xero, cost advantages such as BHP with their scale of mining, or Woolworths with their distribution dominance. Also things like switching costs like Adobe Creative Cloud, Microsoft Office, and that kind of thing. Proprietary technology that people can't necessarily copy easily. There's also things like regulatory barriers. For example, banks and insurers have quite large regulatory barriers so that not anybody can just come in and start a bank. Distribution advantages, superior logistics, supply chains, that kind of thing. Could be something like data dominance such as Google. So there's a whole range of defensible advantages versus competitors that you could consider. Is this company going to keep this advantage in the long term? Number 16, are insiders or institutions accumulating rather than selling? Often it's really good to look at what institutions and insiders are doing with their shareholdings. If they're accumulating, that might mean that the investor sees more value in that stock than what it's worth right now. But if they're selling, that's the opposite, and that means that they may believe that the stock is overvalued, but it could also mean that they're changing their direction or focus. So just be wary. Some companies may change their investment focus, and while that could be a negative thing for the company, it may not necessarily mean that the company is declining in value in the future. Just keep an eye out on what insiders are doing, and if they're accumulating, that's great. If they're selling off like wildfire, maybe it's time to have a deeper look at the company. Number 17, is the business well positioned for current macroeconomic conditions? One example of a macroeconomic condition is when the economy is not doing so well, fast food chains tend to do a little better. It's almost like the morale of people declines, so they go for the easy, quick fix when it comes to food time, and things like fast food chains go quite well. On the flip side, when business is booming, B2B type businesses can often do quite well. So what's the current macroeconomic condition, and how does your company that you're researching fit into that economic condition, and what are the implications of the actual business itself? Number 18, does the stock have sufficient liquidity and market depth? When you talk about things like micro caps, the small stocks that are under $1, often there's low liquidity and market depth. When it comes to buying large portions of that, it's about scaling in. And also when it comes to selling off, it's very hard to do that quite quickly without moving the price or not getting as good of a price as you would expect, or being able to get out of enough of the stock when you want to. I think when you go to sell, if there's only 1,000 units that you can sell into and you've got 100,000 units, it's going to take a very long time for you to get out of that position. Sufficient liquidity and market depth is an important concept, particularly when it's time to sell. And down the bottom, we've got the notes that we add so that we can share and use our PDF as well. So let's say we type in the stock code, stock name, the current price, the research date's automatically populated, and then we add our research notes in here. And then when we go up to the top and generate the PDF, that will show in the output so that you can keep track of what you've done. Once you've scored your stock and you've added all of the details down here, so let's say we've done BHP, you've put in the stock name, so BHP Group, you've got the current price of $42.17, the research date is automatically populated, and you've added a few notes about the stock so you can remember the key points that you've researched and you can compare that to other stocks in the future. What we can do now is either generate the PDF by clicking this button, and you'll see it'll produce a report. You've got the stock notes there, you've got the score, and then you've got how each question was scored. So you can see 3 out of 5 here. What you can also do is share the link on Facebook or LinkedIn. So let's share it on LinkedIn. So I'll just say like, found this stock using the Scanify screener. And then let's say I post this, but the link will lead to the actual checklist. so that people can actually come and see what you scored the stock as and so on if you wanted to share that with an investment group or your investment partner. So it's easily shareable. You can do all your research, you can compare later on, so you can actually keep your own links and review the notes later on. So the point of generating the PDF is so that you can store your research, review it later, assess how you went and how you could actually improve your research, as well as compare against other stocks. So you'll have a checklist score in the end, and you'll have some notes so you can easily remember what research points were used and what you found that was good and bad about the stock